This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of July 7th. Well, this is a tale of two tech indices. The Chinese internet stocks traded on American markets and Chinese technology companies traded with so-called A shares in China's domestic market. And as you can see from the chart of the day, they have moved in opposite directions. The popular ETF KWEB of Chinese internet stocks has gotten absolutely crushed from a high of about 102 at the beginning of this year to the low 60s at the moment. But at the same time, the technology component of domestic Chinese stocks, that is the tech sub-index of the CSI 300, is up about 20%. They've gone in opposite directions. Well, what's going on? What's going on is an economic war, specifically a tech war, between the United States and China. China's President Xi Jinping yesterday gave an extraordinary speech where he denounced technology blockades and said we must oppose anyone engaging in technological blockades, technological divisions, and a coupling of development. And right after that, the Chinese government basically torpedoed the just completed initial public offering of Didi Global, a new ride-hailing app, by saying that Didi had not taken adequate measures to ensure data security, and it was suspending downloads of Didi's app. And of course, that stock got crushed. It did so to two other Chinese stocks as well. China's new concern with data security has a double content. Number one, remember, if computer chips are the engine of the new digital economy, data is the fuel, and China has an enormous advantage in data. Its political system allows it to gather data without the privacy protections that exist in the West, so particularly for things like medical records, China is way ahead. China is telling the West, you can try to deny us access to computer chips through sanctions, but we can deny you access to data, and by the way, we can build our own chips. And that takes us to the tech component of the CSI 300. Absolutely off the charts are the stocks of Chinese companies that are benefiting from a $1 trillion all-country effort for China to establish semiconductor independence, directed by Vice Premier Liu He, a close political associate of President Xi Jinping. China, I'm told reliably, is already able to produce a great deal of the chips it needs in the so-called 14 to 28 nanometer range. That's 2 or 3 generations ago. It's not the super fast stuff you'll find on a high-end smartphone, but it's plenty to power automobiles, 5G base stations, and in fact, about 90% of the applications out there. So China is battening down the hatches for economic or tech war with the United States over the long term. It's saying in effect to the U.S., you threaten to stop U.S. investors from buying Chinese stocks. We don't need your investors. We've got plenty of capital at home, and we'll tell Chinese companies to go do their IPOs at home. And at the same time, they're rapidly moving to build up their own independent semiconductor capacity. So they're big winners and big losers in this. And we've just seen two of the great examples with these two Chinese tech indices. This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City.